Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark and in this week's episode we're joined by Chris McDermott. Chris is a property investor and he's also an expert in supported living. And yeah, he joins us today to talk about both his property journey and to give us some insight into supported living as an increasingly popular strategy for occupying properties. So hi Chris, how are you?
Hi, Mark. Very well, thank you. Thanks for having me on.
No, you're very welcome. You're very welcome. Thanks for joining us. Plenty to get through in today's episode, so we'll try and go as detailed as we can, but keep it moving along at a good pace. There's loads to cover off. We'll get to supported living in a second. That's becoming increasingly more popular. We certainly have a lot more conversations around it as an occupancy strategy for people's property as they try and find ways to make their property portfolios work. But before we do that, do you want to give us a quick introduction and a bit of background on yourself?
Yeah, of course. So I started investing in property alongside my full-time job. Got to a decent place where I was getting some good cash flow from it, enabled my wife to leave the corporate world, and then I followed relatively shortly after. For me, the jump into supported living was at the point where we really needed the portfolio to support us on a monthly basis in terms of the cash flow that it was delivering. When we were analysing how we were making money and where the gaps are, we realised we weren't making as much money as what we would have liked, and we were just keen to optimise it. And that was when we moved over the first property over to supported living, saw the benefits of that, and then continued to move the majority of the portfolio over ever since. And now that's all we focus on in terms of new acquisitions.
Yeah. Okay. Nice. Thank you for that. Yeah, and that's interesting actually, because it's good to hear that obviously you tested one, made sure that worked before moving across, whereas we've got some people who are considering moving the whole lot over. And I think that probably comes with pros and cons to it as well. So any lessons that you learned in the first one that you thought, actually, we'll try and avoid doing that next time?
The first one was actually worked perfectly. And that was the reason why we really then looked to focus on it. Because we were at the point where we had a decent sized portfolio. We were paying sort of 30K of agency fees. And the option for us to move it over to supported living or get our own in-house property manager. And we thought, right, we'll try supported living first. And we actually ended up doubling the profit of that property through the transition and moving it over when you consider all the costs that we used to have versus just the net profit that we're getting now. And yeah, that one just worked so well. That was then the reason for moving the majority over. We've learned a lot of lessons since in terms of there were certain properties that didn't go quite according to plan, which I'm sure we can get into. One of them, and then we're going to cover a bit around the due diligence of providers, but there's certainly some watch out with some providers and making sure that they've got the right relationships in place with the councils before them agreeing to take your property on, because a lot, or at the point in time where we had one, they were looking to use our property as a way to get in with the council. So we were sort of the guinea pig, and it just took a lot longer than it should have. And so our void period was a lot longer than it should have been. And yes, a lot of lessons learned from that, like I said, we can talk about in terms of things to avoid. But overall, it's been a relatively smooth process, but we've definitely learned from each one.
Yeah, lovely. No, and perfect. Thank you for that. So I think, that's a perfect segue into diving into more detail around supported living. So it's something that people say, they're going to look at from a property occupancy strategy. This isn't a property type, it's the occupancy that we're looking at as opposed to the property type. supported living, social care, it comes in all its different guises. I think supported living is kind of a catch-all statement for it, or social housing providers. Do you just want to give us an overview as to what supported living is? And then we can get into the nuances about how that differs from provider to provider.
Yeah, so different people will categorize it in different ways. The way I look at it to try and streamline it is essentially you've got social housing, which would be letting something direct to the council, and that the tenant type within that doesn't actually get any support other than financial support. So that would be social housing. The minute they get some level of support over and above just financial support, that then comes into the supported living category. But there's a real broad spectrum of what can sit within it. So the lowest being touch point care, where they might also receive financial support, but it will be some additional support. For example, it might be women fleeing domestic violence, for example. They will get counselling support, moving in accommodation, but they're vulnerable tenants and they will get a certain type of support. But it's not like they need 24-hour care. It's just, it might be that you've got a support worker assigned to them, and they might have another 20 individuals that they're looking after in terms of that support worker. Then you go into more mid-support, where I'd say an example would be 16 to 18-year-old care leavers, for example, where they will have a support worker or a care worker living with them full time, but they might be in a HMO where they're with 6 other care leavers. And then you go into real high support need, where it might be someone with autism or mental or physical disabilities, where they might need one-on-one care or even 2-on-1 care. And the lending requirements for or the type of lenders that you can go for will vary depending on which of the 3 sort of segments that I've described, which of the 3 they sit in.
Yeah. Okay. No, great. Thank you for that. So yeah, there's obviously a spectrum as to how this is, and I can see really easily how people can get lost in this whole process, because I think it's banded about that you obviously just get a contract for 5 years, you get it occupied, you put certain type of tenant in there, and it's a set and forget type strategy. I get it. I understand exactly why that would be attractive to people, but yeah, you need to understand exactly what you're moving into. And I think for the purposes of this conversation as well, it's really important for us to clarify that this is an investment strategy in so much that you own the property and you're letting this out to a third party. So the bits that you touched upon, which were, where you go right up the spectrum and you've got autism and so on and so forth, this is not about actually operating the facilities yourself. This is about letting it out to a registered provider or a service provider, which we'll come into in a second. So yeah, this is very much third party letting out rather than trying to operate this business yourself.
Exactly, yeah.
So in regards to service providers and registered providers, it's something that I forever get the wrong way round. Should know it by now, but easy mistakes to make. So as I understand it, service providers often in a head lease, registered providers in a sublease. We'll come on to the head lease sublease thing in a moment. Do you just want to help us understand the difference between service providers and registered providers, please?
Yeah, so the challenge with it is that not every agreement will always be in the same way. So I suppose what will always be in place will be that you've got a landlord who generally owns a property. They then can let to a service provider and have a lease with them. Now, that service provider, depending on their setup, may or may not have then links to a registered provider that then they have an under lease with, or a separate lease that will normally reflect the same terms as what you have agreed with that service provider. You could, in some instances, just have a lease directly with an RP if they're the ones that are also going to do the care element of it. But if you imagine it, the care provider is almost like an outsourced element of an RP. And that's generally the way that it works. But as I say, it might be that you have a care provider that doesn't actually need an RP that sits behind them. The benefit of having an RP is that the council, who is, if you think the source of the funds go from the council to the RP, to the care provider, to the landlord. If you have an RP involved, then the council can claim back their funding from central government. And so the councils favour having an RP in place. And generally, RPs will only work with certain care providers. And so it does give a level of strength to the covenant if there's an RP in place. So that would be the benefit. But like I say, not all providers need an RP. They may just lease directly to you and have relationships direct with the council.
Yeah. Okay. And that for me is where kind of the nuance tends to sit in this. We understand if you let direct to the council. We also understand as you get higher up the spectrum, it becomes far more niche. And in fact, the conversation will probably change anyway. So most people will be in this parameter, I guess, where service providers, registered providers will come into play and so on and so forth. So just so that I think I've got it straight in my head. So effectively, am I right in saying that service providers could have multiple registered providers underneath them? So they effectively act as an agent where they collate all of because the registered provider, I'm assuming, doesn't want to deal with 1,000 landlords, then will engage a service provider who effectively becomes an agent of some description.
Yes, So it may be, I suppose you think about it like the RP is, may have a contract with the council to look after to support X amount of vulnerable people, or may just have the contract for adult social care, for example. And then they will then decide, do they want to do that themselves, or do they want to outsource that to a care provider? And that care provider, an RP may have multiple care providers that sit underneath them that then will go and speak to individual landlords. So you've pretty much outlined the structure. Yeah.
Okay. Fab. No, that's great. And then with regards to the lease arrangements, so I just want to spend a bit of time on this so that we can help listeners understand how that can change. And ultimately, I'm coming from this from a mortgage perspective. So, the arrangement makes sense from a commercial perspective, but then ultimately people want mortgages, and then that feeds back to what the lenders are prepared to accept or not. So I mentioned previously about head lease and sublease. Again, for the listeners out there, just talking about the head leases ultimately. So I would let it out to a service provider. So I would have a lease to the service provider. Let's say that's 5 years, pay me X pounds per month. The service provider then would relet, so sublet or underlet that property to the registered provider. And then that registered provider will ultimately put the tenant in situ or the occupier in situ, depending on the agreement. Is that right?
Yeah, all up until that last bit where it might actually be that the care provider is the one that may actually deal directly with the council in terms of the referrals from those clients. And then they may be the ones that are responsible for putting those in the property. But all up until that point was 100% right.
Yeah, okay, fab. There we go. So this starts to get a little bit confusing, and you can see then why people who are new to this space can really struggle or actually get themselves tied up in knots completely.
And a lot of the time, the provider or the people that you're talking to may not ever reference that there's anyone else sat behind them. We weren't aware of that. When I mentioned the first one that we signed over, we had no idea that there was anyone else involved in the arrangement. And you don't necessarily need to know. But obviously you should know, because they're an interested party within the chain, and so you should want to do your own due diligence on them. But a lot of the providers who the landlord's going to be talking to may not actively look to bring that up. So you've got to make sure you're asking the right questions.
Absolutely. And then by the time you get the head lease through, there will be a clause in there around underleasing. And, as we've seen in our experience, that may not be that may not make up a large portion, maybe one paragraph in a fairly extensive contract that subsequently allows them to underlet or sublet. And then we get into the difficulties from a mortgage perspective.
Exactly. And sometimes I feel like the people at the who are at the lenders, it might be the point of contact, so the lender doesn't fully understand it, because typically a sublease or an underlet sounds like a real negative, and it's like you've almost lost control of who your tenant is going to lease the property to. But in actual fact, a lot of the time, having an RP involved actually strengthens the lease and strengthens the covenant, because they might be a blue chip RP, multiple years of experience, big financial player. And so actually having them involved may strengthen the position, but it doesn't, when you just talk about an underlet, it doesn't sound like something that you'd want to do, like your tenants then letting out the property to someone else. Which is where we feel like sometimes there's certain lenders might struggle with understanding the benefits of it sometimes.
Yeah, and this is a progressive space. Whilst it's been around for a long time, social housing and this sort of care assistance, it's growing in popularity. Therefore, more lenders are starting to wake up to this and starting to bring in their own policies. I guess the challenge from a lender's perspective would be around the problem is if, say, the head lease failed, as in the company that has the head lease fails, that brings a whole raft of legal issues around the subletting element, and ultimately who's paying the rent, who collects it, who's to be there, how do you get control of the property, and so on and so forth. I suppose a happy place would be if lenders understood or undertook some due diligence on the RP and the service provider. That may help from that perspective as well. Unfortunately, just like subletting, no.
Yeah, exactly. Yeah.
I think we'll get to that space. There are a couple of lenders that will do this. So again, just for listeners' perspective, this is all fundable. It just the more nuance that your arrangement becomes, the fewer the lenders are that are ready to step in and provide mortgages for it. As we've learned, Chris, I'm sure.
100%. Yeah.
So, okay, well, that's really useful. So hopefully, we've just given an overview as to what this space looks like, who the providers are. A couple of words, or we've mentioned it a couple of times now, vulnerable tenants. And you mentioned, obviously, domestic abuse. Do you want to just go through what vulnerable tenants sort of covers?
Yeah. So as I briefly touched on before, it can really vary, and it's really important to understand which providers you want to work with and who they are specializing in supporting with. So it might be sort of, as I said, on that touch point care, a lot of people think we may be talking about asylum seekers, and generally you've got some big players that deal with them. So Serco, for example, the biggest one, and I see that more as sort of the social housing. But then we deal with a provider who supports refugees. So once they've been given the right to remain, they then help them get set up with accommodation, a bank account, and helps them then enroll in English lessons and just try and help them positively contribute to society as quickly as possible. So we'll work with, so that might be an example of the touch point care ones, helping women fleeing domestic violence, care leavers, autism, mental physical disabilities. Those would be some examples. We've got people that have suffered from drug and alcohol dependencies that then have care. But the key thing around it, I would say, is obviously as a provider, they could look after a broad spectrum of these client types, but obviously the care that each different one is quite bespoke and unique. And so what we find works really well is if you deal with a provider that just focuses on one, maybe two types of that care type, and what you generally find, and we're sort of moving into the bit of the due diligence side of it, is that the founder is often affected by one of the sort of, I suppose, the needs that they're trying to solve for. And they're the ones then that you just get the right feeling from him in terms of, and one of them said it to me, like, we're in it for the need rather than the greed. And they know what it's like, and so they've set themselves up effectively. But generally, they're the sorts of providers that you like. And then because of that, they are quite niche in terms of the care that they give.
Yeah. And I guess, again, coming at this from a mortgage perspective, so lenders have vulnerable tenants policies themselves, so they will lend to certain types of tenants. Others that were on that list are possibly people coming out of prison, going straight into accommodation or temporary accommodation until they move on. And so on. I guess one of the issues that we tend to find from a mortgage perspective is, as you sort of said there, is they may focus on a particular type of occupant, domestic violence or what have you. However, their website will promote that they do a big range because they technically can, and that can cause us a problem where it comes to mortgages. So that's something to bear in mind as well.
Yeah, 100%. I remember between us, sort of, you'd flag that to me, and we had to actually actively go to one of the providers and ask them to change their website because it wasn't true. At one point, they were looking at, dealing with referrals from a number of different sectors, but they didn't. And so actually it was hindering our chances of getting the mortgage. So, it's making sure that they're reflecting themselves in the right way as well.
Yeah, fantastic. So again, these are things that if you've got a good relationship, then and you kind of know what you're doing, then you can have that conversation. Say, look, you're going to stop me getting a mortgage off the back of it, and a lot of them will play ball. With regards to, so we mentioned due diligence. Now, what surprised me when we were dealing with some of these service providers, in particular, that I've come across, is that the age of the companies, some of them were less than 18 months old and, very new startup, winning some significant contracts and so on, which I found surprising, if I'm honest. That then led to the question of due diligence and so on, because obviously they financially could be not as stable as they need to be and bits and pieces. And I guess unless people are aware of this, they could be, getting into arrangements with companies that are not the best to be getting into arrangements with. Do you just want to chat through around some due diligence? I know that you do spend a lot of time in this side of the business.
Yeah, so we generally have a 3-point process to our due diligence with providers. So we will have background information checks that you can find out. So going on company's house, seeing where they were established, looking at their financial records, looking at websites, social media profiles, all things that you could just see without having a call with them. Then after that, we'll then have an initial screening call where we'll ask certain information around where they're registered, how they're set up, how they get their referrals, what's their relationship like, what contracts have they won with the councils. And then sort of that then gives you a sense of whether the type of people that you want to work with, and then a more in-depth call or meeting with them where you just get more of a feel for them as a company, their culture, their values. And we have quite a few hypothetical questions we'll ask at this point of, if a tenant did this, how would you respond? How would you deal with this situation with a neighbour? Because the vast majority of the time, or the only reason why I've ever heard of the break clause being executed within the lease is issues with neighbours. And so neighbour management and how proactive they are with that is critical. And then obviously, with the tenants, how they manage the tenants is really important. And within that, it's what agreements they have with their clients. So again, it will vary, depend on the sector and the provider. But if you're dealing with that touch point care, what we like to see is that they have licenses with their tenants rather than ASTs, because a license comes with the benefits that if they essentially, the clients don't get rights to the same that you would under the AST. So if they caused antisocial behaviour, the provider can ask them to leave within 24 hours notice. They don't have to go through that full eviction process. You do need to be wary. You're dealing with a certain tenant type, and you've just got to make sure that you're doing as much as you can in terms of mitigating the risk of that. Touch wood, we've not had any bad experiences with it. We've had a couple of times where a neighbour has got in touch with us and said, this, I'm not sure what's happened, but a new person's obviously moved in and they've caused some antisocial behaviour and had guests staying overnight, which is against what's within their terms within their licence. we've told the provider's got them out within 24 hours. And so there is still risk associated with it, but it's around making sure that yeah, like I say, those can be mitigated, and it's around how the provider deals with those situations. But yes, it's important to go in with your eyes open.
Yeah, fantastic. And in regards to that, I'm aware that some of these are charities, some of them are on the FCA register, and if they are on the FCA register and charities, their financial reporting is pretty extensive. They've got to do at least annual reporting of probably a strategy. And if you've ever seen a set of accounts on Companies House, you'll know if they're non-audited, it's very, very light. It's just balance sheet. I think that's changing next year. But you can really do a deep dive in on these firms to see what they're like, basically how many properties they've got, their turnover, their strategy for next year, and so on and so forth. Yeah,
exactly. And that's part of sort of, like I said, our pre-screening check. Other things like who are they regulated by? So is it CQC? Is it Ofsted? Some may not be regulated and they may not need it, but a big change in the last 2 years was anyone dealing with care leavers is now regulated by Ofsted, which has just improved the standards that the properties need to be. So, we see it as a real benefit having that area of regulation, but it's just making sure that the provider is aware of what they need to be regulated by and they're sticking to them sort of standards.
Yeah. Okay. Fab. And CQC is something that comes up a lot in some of the conversations that we have in this particular space, because we tend to speak to a lot of people who want to consider doing more of the children-based care. I can see the financial benefit of some of that. Absolutely. Obviously, people need to be doing this for the right reasons, and so on and so forth. And the CQC piece is something that gets overlooked sometimes, on how the barrier to entry is very high in this space. So that's something to bear in mind. I was going to touch upon, actually, in Wales, again, appreciate we're under different jurisdictions, is that in Wales it's becoming less favourable because the government have bringing in some policy. I don't know exactly what it's going to look like yet, whereby they don't want private landlords to benefit financially out of government contracts, effectively, care contracts. So that'll be interesting to see how that pans out. But I know that England is untouched in that regard. So again, that's something else to be aware of, is what's the longer term strategy with all of this going forward as well.
Yeah, and it's forever changing, and staying on top of it for us. I know we were talking a bit before we jumped on, in the majority of, so I suppose our businesses, we have assets that we own, properties that we own, which we've moved on to these leases. But we have another business where we help other landlords move their properties over, and we help them benefit from our relationships that we've already built, and I suppose all the knowledge that we've just talk through in terms of all the checks that you need to do. And the majority of our business was helping landlords move their HMOs over in Manchester. And actually, a lot of the council areas within Manchester have put a pause on taking new properties on because of the amount of properties they've been bought, as in terms of being proposed to them. Now, the demand is definitely still there from their end user, but they just want to make sure everything is bedded in properly and got the right structure and processes in place, because they've been somewhat overwhelmed by it. So that's massively changed our business. And in terms of what we're looking at, there's obviously Article 4 and general property challenges, that there's just some additional ones obviously within this space you just need to be aware of.
Yeah, and that leads us quite nicely actually onto the property types as well. So you mentioned HMO. I know you're diversifying into other types of property as well, which lends itself to that. And we spoke about both the property type and financial viability of those property types. Do you want to share around some of the thought processes? Because all property types lend themselves to this type of occupancy. However, not all property types lend themselves to commercial viability of this type of occupancy, because you're subject to local housing allowances and what have you. Do you want to share that?
Yeah, I mean, so generally the benefit of this, of how the financial model works, is generally you get slightly less gross rent, you could look to get the same. But the benefit is the provider takes on the responsibility of the bills and day-to-day repairs and maintenance. So if you think of that within a HMO where the landlord is responsible for the bills, if you're getting slightly less gross, but you're getting all your bills taken away, net profit wise, you can achieve a higher net profit, particularly if you factor in one of the biggest benefits in that you get no void periods, you get no tenant turnover, no agency fees, no tenant fine fees, all of that that's associated with it. So generally that was where the majority of our portfolio was from a personal point of view, and that's then when we've been able to help other landlords. Other people can do it with single lets, and again, it might, depending on what the LHA rate is in comparable to the market rate, you can make that stack if you consider the benefits of long-term leases, no void periods, no day-to-day repairs and maintenance, sometimes the compliance costs as well being sit with the provider. But obviously on a normal buy-to-let, a lot of the day-to-day running cost sits with the tenant anyway. And so therefore the swing isn't as big in terms of not having them bills. And then on the other end of the spectrum, what we're looking at the moment is multi-unit blocks. So block of 10 apartments that we've just put through planning. We're looking at sort of market rate from a rent perspective, because the demand's so high, you can get better market rate. But then obviously you've then got the benefit that that's then on the long-term lease. So you're getting your costs taken away, but because there's communal spaces within that building, even though they would be let out as single lets, so you wouldn't have as many bills responsibilities as a HMO, there will still be some. And the fact that we're not getting any of those and we won't have voids means that overall the financial model works a lot better for us. But there also is an element of the gross rent. So social housing, if I go back to where I started, social housing will just get LHA rate. This supported living generally falls in a sector of exempt rent where they're not tied to the LHA rate. You might get LHA plus 10, 15%, depending on which provider it is. And that's for sort of the touch point care. As soon as you move into the mid and the higher care, their funding comes from adult and children's services, where it's not necessarily tied to the LHA rate. They may peg it to it as a sort of yardstick that then they're comparing against, but that isn't where their funding doesn't come from housing benefits, so that it doesn't need to. And I suppose it's understanding where their funding comes from, what's a fair rent that you expect, and that will obviously depend on how high the demand is, what their alternatives are. And sort of if you consider with one provider that we work with, where it's people dealing with drug and alcohol dependencies, the clients that are living in the properties would otherwise be in hospital, and so they would be costing the NHS a fortune in terms of giving them a bed there and all the care that they would get in hospital, which they don't necessarily need. They just need a certain type of care, which actually, if they all live in in the HMO, which is managed by this organisation, where they give them very specific type of care that they need, that's actually a lot cheaper for the council than if they were in hospital. And so therefore, and their funding, it comes from adult social care, and so they actually compares market rent for that. But it's just, there's a lot of nuances within it. And I've realised as I'm talking a number of nuances, but it's important to just understand the provider, where their funding comes from, and ultimately what you need to make it stack. But most of the time we've been able to find a solution within supported living where it's a real win-win for the provider and us, and it works, and we've continued to grow in the sector.
Yeah, and I think the point here is that it's not as straightforward as some people make it out to be. Absolutely, there is merit in researching this and looking at this as a genuinely viable option for your properties, especially as we're seeing increased legislation in the standard buy-to-lets and so on and so forth. I can see the appeal for it. I guess the warning is tread carefully. No, and same as anything really, isn't it? Is understand what you're doing. And if you don't go and get some proper advice or support to navigate what can be something that's pretty complex.
Yeah, and I'm hoping I'm not scaring people off it, because for us it's been amazing. It's given us a very consistent monthly income that's, net profit wise is higher than what we were experiencing from professional HMO. So it can work amazingly well, but the more we've got into it, the more we've learned about the nuances within it, which obviously, hopefully other people can benefit from our sharing.
Yeah, and look, we do this all the time. We go into the detail of it. It probably, we want to pull out the warts and all type stuff to it, rather than just put a shiny veneer over the top of it and just promote it as this thing. The same with all types of finance and property and what have you. Everything can have a sting in its tail if you misunderstand it. And the people who find that it hasn't worked for them have probably gone in 2 feet and not done the due diligence necessary, and so on. So I think it's really important that, whilst we are focusing on some of the negatives or some of the complexities, actually that's where the value sits, so that you can hopefully avoid making some expensive mistakes in this process. So that's really good. Also, we mentioned on property types as well, HMOs. So HMOs obviously lend themselves very nicely to this type of model, but you spoke about the level of bedrooms, and not all HMOs fit neatly into this.
Yeah, so if you think of what a popular strategy, which would be commercial to resi HMO, maybe over 10 beds, for example, they're generally done to like a co-living standard, where you might get considerably higher rent than you would as a, I suppose, in this example, you may get considerably higher than what you would from an LHA plus 10%. And so what we found in Manchester, where we know where the LHA rates are, if you go above £700 per room per month or above 7 bedrooms, then it generally doesn't work financially to move it over to supported living. Now, there's other benefits of it. If you've got, bigger HMO property, you're going to have higher tenant turnover, you're going to have higher tenant fine fees, for example. So there are some benefits to it, but generally financially you're not going to be as well off. And it's just a simple fact that on a larger HMO, you've got your costs don't rise at the same rate as the amount of tenants that you've got, because your broadband bill isn't going to go up from if you've got 4 versus 5 tenants, for example. So you split that cost over 5 bedrooms. So the more tenants you have, the more those costs get diluted. Whereas on supported living, obviously the benefit is you take them costs away. So on a smaller HMO, the swing in the financials of removing those costs makes a considerable difference versus a larger one.
Yeah, absolutely. And equally as well, not all landlords, whilst they should and do look at their financials, not all landlords want to go into the space purely from it makes financial sense. So, some people want to do it just because they want to be doing the right thing, and so on and so forth. So, people have different investment objectives. We're just focusing on some of the ones that, some of the metrics that are the easiest to measure. Metrics around preference and that, that's a very personal thing, and a very personal reason why somebody may want to go into this occupancy type as well, off of the back of that. All I would say is, if you are a landlord and you've got a property, the commercial still need to ultimately make sense. Otherwise, it's gonna not work going forward on that front. You mentioned as well you've got a checklist that you can share with people in regards to the due diligence.
Yeah, if anyone I'm sure we'll share the details in the show notes. But if anyone wants to get in touch, and happy to share our due diligence checklist. Just the more properties that can go to the right providers in this sector, the better for everyone, really. So obviously happy to share that. Yeah,
no, fabulous. That's cool. Excellent. Thank you for that. So we spoke about LHA. We've used LHA a lot, actually, as an actual local housing allowance. Could you just share a little bit around what that is? So you mentioned, obviously, that comes from housing benefit and so on. I think that's just interesting, just to clarify how LHA works in that regard.
Yeah, so if anyone's interested in looking into where would their properties be viable, if you just Google LHA rate, you'll then be sent to a government or sort of YouGov website, and you can type in your property's postcode, and then it will have a specific local housing allowance rate for that postcode, and it will give you the shared rate. So HMOs will be under the shared rate generally. Then 1 bed, 2 bed, 3 bed, 4 bed. So those are the rents that would be payable by the council as part of housing benefit for anyone within either social housing or, as we said, supported living. However, with supported living, it's actually exempt rent, so they can generally pay higher than just the LHA. So we always use LHA plus 10% as our worst case scenario in terms of what the providers can pay, and then obviously you then remove the day-to-day running costs versus a professional let.
Yeah, so I guess the point there, that's a really quick methodology just to understand what your local LHA rate is, plus 10% or just even flat at LHA. If it works at that figure, then it's going to work at every other figure. That's the lowest it'll be. So I think that's really important to remember as well on that front. So that's really handy. Really do appreciate that. And I think from my list of questions, that's pretty much everything I've got. We've covered a lot, in fairness, to be fair. So I think, is there anything else that you think we've missed that we want to share as well?
No, not massively. I think if anyone wants to get in touch and find out more around the due diligence, happy to share that. I think one of the biggest lessons that I've had as part of it is obviously getting that right, but then before taking any action, we have got pre-leases in place with the providers where we will get all the agreements signed up and confirmed before we then, for example, if we're going to buy a property, we would purchase it. So before we exchange, we will then get the pre-lease in place, and the benefit of that is you've sorted your exit out prior to any financial outlay. So we put that step in place. And I mentioned right at the start, in terms of being the guinea pig, we were left in a position where we'd actually had a property where it was previously a professional let. We had a number of tenants move out at the same point, and there were some other tenants in place that we helped move on elsewhere because we wanted to move it over to supported living. But at that point, we then went to give it to the provider, and actually they weren't able to give it to the council because they didn't have the right relationships and contracts in place in order to do that. And that was a massive learning from us. We didn't have that pre-lease in place, whereas obviously as part of our process now, we'll always do that and make sure that as part of our due diligence, we'll ask those questions. Because a lot of providers, if they're new, they may look to get into the council, and the best way to get into the council is say, look at this lovely property I can give you. But you don't want to be the guinea pig with the property they're using. You want to make sure they've got the relationships in place already, and you're just following on from someone else's or relationships that are already established.
Yeah, no, thank you. That's a great point. When you consider, obviously, if you've got your own property and that's fine, and you're looking to let it out, that's one scenario that it can bite you. Another is if you've specifically gone to find a property to take to a provider, you may have got into bridging, investment, refurb, etc., etc. And if you haven't got your exit well thought out, or as you said, pre-lease, then that could lead to all sorts of pain if you get to the end and you can't actually get it occupied by someone, especially if you've done it to spec as well.
Exactly, yeah, 100%.
So in regards to this as a strategy, I think overall we can say like it's a great opportunity for in the right location for the right investor with the right provider. I guess this is very much viable. I can see the appeal to it. It's very much a set and forget. They might take a degree of work at the front end, but the benefit will pay off over the longer term. So there's all of that sort of stuff. I guess with all of these things is just simply the health warning is just do your homework. Don't just run into this thinking this is super easy and you're just going to sign a contract and it's done. There's mortgage implications, there are lease implications, tenant implications. There's quite a bit to consider. And Chris, I know that you mentioned it briefly, but I think it's important to mention again that you actually do offer a service which means that you can support any landlord that's considering getting into this space. You actually provide a direct service for that?
Yeah, so there's two services. So the first is if they've got properties within Greater Manchester where we already have established relationships in place with providers, we do a lease arrangement and a management service. If it's multi-unit blocks, we can do that over the whole of the Northwest. If they're outside of that area, we offer just mentoring service in terms of the very start and all the way through to handing over the properties and covering all the elements that we talked about in terms of finding the right properties for the providers, all the due diligence, getting your any financial implications that they need to consider, and just try and make the process as smooth as possible and avoid the pitfalls that we failed to and a number of others have.
Yeah, no, I think, and that's great. And as you said, your contact details will be in the show notes. So if anyone listening to this resonates with you, then please do get in touch with Chris, or alternatively get in touch with us, and we'll put you in touch with Chris in regards to that. As I say, it's a great opportunity, but one that needs to be navigated sensibly and safely to avoid the pitfalls. So yeah, thank you very much for that, Chris. I really do appreciate it. Thanks for your time. And great conversation as always. Look forward to catching up again.
Perfect. Thanks, Mark. Nice to speak to you.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.